Good morning. Today I have a pleasure to talk with Juraj Hrabate, CEO and founder of Finax. Hello.
Hello. Hi.
And we're going to talk about ETFs, about passive investments, and about robo-advisors. So a lot of very interesting topics. I would like to start with the topic of passive investment and of ETFs. ETFs are one of the most popular financial instruments all over the world. So what's the why they are so popular and getting more and more popular among investors?
Well, basically, mostly we talk about return. And when investing, we talk about return and risk. And throughout the time, for the last maybe 40 years, since the first ETF has come into real life, we've realized that most of the ETFs are actually earning and performing much better than the regular active traded funds. In US, it's considered that only 6% of actively managed funds are performing better than the average passively managed ETF fund. And in Europe, for example, this percentage is only 2%. So the passive invested funds are beating 98% of the actively managed mutual funds. For example, in Slovakia, there is no active managed fund that is beating the performance of the passively managed funds. So basically, and it's a very similar situation, I guess, is also in Poland. So if you have only such a small percentage that your investment within an actively managed mutual fund is going to beat the performance of passively managed funds, why would you do it? And why would you invest with such a small probability of outperforming the market? And basically, what is beautiful about ETFs is that you actually buy the stocks of almost all traded companies. So you don't pick, you don't try to find the stocks that are gonna perform the best, but you actually buying all the stocks on the market, and through that you are getting the advantage. It's very, very cheap. You get a very diversified portfolio, plus you get almost market returns, which in a 98% are performing better than regularly actively traded mutual funds.
Mm-hmm. So what kind of return rates can I expect from most popular ETFs? That's a very tricky question, but I have to say that.
Well, basically, it's not a tricky question. I mean, passively managed funds are trying to perform as much as market performs. So if we, for example, take historically that S&P 500, which is the, let's say, most popular index in the world, is historically gaining 10.2%. The average ETF is earning almost that, or maybe roughly 10.1% on average. However, actively managed funds, depend where, they usually underperform on average 2 to 3%. In Central Europe, where we see that the costs of the actively managed funds are regularly higher, for example, they average somewhere between 2 to 3%. In Poland, actually, the average is climbing almost to 3%. Usually, those funds are earning around 4 to 5% less than passively managed funds. It's because of poor performing of the managers. It's because of the fees, etc., etc. There are like multiple reasons why is that. And as well, if you take it, for example, if you have an actively managed fund in Poland which has 3% fees, that means you need to be equal with the market performance with the passively managed ETF fund. You need to earn 13% in order to get to those 10%. If you want to overperform, so for example by 2%, you need to earn 15% in order that after the fees it's going to be 12. But in order to get those 15%, you would either has to be very lucky, or you would have to invest with a very much higher risk in order to get the return. So it's not so, we shouldn't be only concerned about the return itself, but we should be also concerned about the risk-weighted or risk-adjusted return.
So we can assume that passive investments are better than active. Can you agree with that?
In general, yes. Well, in general, at the moment, it is. And that's why most of the Americans are switching to passively traded index ETF funds. That means at this moment, more than 50% of US American investments are invested within ETF funds. And this trend, I think, is coming also to Europe. And I mean, why would you invest in active funds if you have 98% chance that you will not do better? That's a very simple question.
But there's one problem. ETFs are just following the benchmark, so it's great. It's a great solution during the bull market. But what about ETFs when we got bear market?
Well, this is a very good question and very tricky questions, obviously. But this is what active investors or active fund managers are always claiming, that they do better than, or they can do better in terms of when the crises are coming, when we have bear markets. But actually that is not true. And we're going to prove the results and show the results very soon within also our website, where we compare the results of our passively managed portfolios compared to actively managed funds who are having the same risk. And for example, in Slovakia, our strategies has beaten the most popular actively managed funds during this last half year by 7 to 10%. And on average, we are talking about 5 to 10%. On average, we are talking about 7%. We've outperformed the actively managed funds. And I'll tell you why is that. Because and for the last two bear markets we have, one was 2018, which was very, very short, and now was the second bear market after about 10 years or 11 years to be precise. Those bear markets has been very, very short of time, and by the time the managers has been able to sell out the portfolio, the markets has started to risen rapidly, and even if they sell some part on some certain amount of stocks during the rallies down, they've been not able to enter the market so quickly, and it took them a couple of months to enter the market, or maybe even most of the portfolios haven't entered the market yet because they are still scared. But as you could see, the markets has gone up more than 20-25% since the very bottom, and if they didn't catch this rise, they will probably never catch it again.
So it's not a good solution to use, for example, inverse ETFs, which earn on losses.
No, I think it's a very bad idea. Actually, I mean, if you see long term, the markets are rising, and so the markets are on generally doing 10% a year. So why would anybody hold an inverse ETF? I mean, we've seen it on many of our clients that wanted to use the situation, wanted to time the market, but they have none of our clients that wanted to time the market, who either wanted to sell, and buy, to sell higher and buy lower. They either sold it pretty well, but they didn't enter the market at the preferable prices because they thought it's going to go up, or they sold it, already down, and never been able to recover from that, because they were not, none of our clients that wanted to time the market has been successful in this strategy, actually.
So not speculation, but long-term investments are the key for success.
Exactly. That's what Warren Buffett always say, just buy S&P 500 index and, or let's say an ETF that is copying S&P 500, and, that's all you need.
And be patient.
And be patient. I mean, investing shouldn't be about short-term gains, investing should be about long-term gains and reaching your long-term goals. If you have short-term money, obviously, most probably investing might not be the most suitable option for you, even though, for example, as Finax, we also have some short-term solutions for clients, but we're still talking about 1 to 3 years, which maybe in terms of like active trading, this is still, this is, almost history time. So we're not talking about days or weeks, or like most of probably of your readers are, comfortable with, because they trade, for example, Forex, etc. But, long-term investing is that investing that creates, the value in long-term. And, I've been doing Forex myself, but if you look at the industry, if you look at the numbers, now they have to, each Forex broker has to release how many of their clients are losing. You see the numbers there. 70 to 90% of the clients of Forex brokers are losing money. So why would anybody try to do something that, probably he's most probably going to lose? And that's why there are so many Forex companies, because they earn, they know that if they trade against the clients, what most of the Forex companies do, they would earn the money the clients are losing. So, it's very tricky. And so after all my experience, I only consider such a long-term investing as an investing, not a speculation.
So what would you recommend to someone who is just starting with the ETFs and with long-term investments?
I would find a very cheap broker where I can easily, with very little extra cost, buy ETFs. So, for example, someone who is starting, we are talking about people who has, 100 to 500 zloty a month for investing, that would like to save. That's, for me, someone who is starting. Obviously, can be anybody with higher money, even one time or regularly. So, to buy, not to pay too much. That means in terms of not only of like fee for the broker, but also to transfer money, to exchange the money, because at this moment it's very hard to buy ETFs in local currencies, even though I know in Warsaw Stock Exchange there are already some ETFs covering S&P 500, but but still the price is a little higher than an average price. So if you are able to convert the money or efficiently in euro, you probably will be better off to buy some international ETF.
So what is the main goal of Finax? Because in Finax we can get an access to ETFs from all over the world.
So we are trying to facilitate investing for either very beginners but also for pretty advanced investors. Basically, what we do, we are creating portfolios out of 10 index ETF funds, which are 6 of them are equity, 4 of them are bond ETF funds. Our algorithm will evaluate the client, will help him to set up his portfolio, will help him to manage his portfolio, to rebalance his portfolio. And what we try to do, we've created a platform where you can start investing beginning with 100 zloty a month up to unlimited amount of money. And with any of your deposit, we will automatically invest those funds within these ETF funds. Within these passively managed ETF funds, and basically take care in the long term. And through this approach, we've calculated, which is a very easy approach. You don't do anything, you basically do a buy and hold. We are beating most of the actively managed funds that are within the Central European region. So keeping the strategy extremely simple, extremely, I would say, understandable for the clients and very, very cheap. And this is most important. Because, for example, if our fee is 1% to manage the funds plus VAT, which is 20%, so 1.2% is the total fee for our management, comparing to, let's say, most of the actively managed Polish mutual funds where they charge 3%, only those 2% in long term can make, for example, in 20 or 30 years, this difference in price can make double in your investment.
Mm-hmm. You mentioned about strategies. So what kind of strategies I can use using Finax?
Well, strategies,
because there are a few portfolios.
Yeah, there are portfolios, but they differ in the allocation between bonds and stocks. So
in terms of risk,
11 in terms of risk. So we have 11 strategies. One is fully equity strategies, then is 90% stocks, 10% bonds, 80% stocks, and 20 up to fully bond portfolio. And we, at the beginning, with some very few and simple questions, we evaluate the client risk. So, for example, if he's willing to invest until his retirement, which is, 25 to 30 years, obviously we know we have a lot of time, and this client should be as risky as possible. But on the other hand, we evaluate his knowledge, his experience, his financial situation. So it's different. For example, if client tells me I'm investing all my money, or if the client is telling me, okay, I'm only investing, a small amount of money each month, which, doesn't cost me any or will not create me big troubles if I temporarily lose 10, 20, 30%. So, based on all these things, we try to evaluate the risk of the client, and each client is then automatically invested within the proper strategy he's suitable.
Mm-hmm. And can I switch between these strategies, between these portfolios at the real time?
Yeah, you can. Well, real time. You can switch the strategies once a year.
Maybe real time is not the perfect.
Exactly. So you can switch between the strategies once a year. For example, if your situation changes or for any other reason, any other time you want to change the strategy, you pay extra fee, 200 euros. But so far, I think only one client has changed his strategy twice a year. So basically, you can do it anytime, and once a week we are changing the strategies. Usually it's Tuesday. So currently, for example, right now, clients that wish to change their strategy, it's being done at the moment.
And you are using maybe not a strategy, but something called rebalancing in your portfolios. What is that?
Well, basically, if you imagine most of the... I start somewhere else. For example, your portfolio is consisted of 40% stocks and 60% stocks and 40% bonds. At some point of time, when for example, the market is in bull market, the stocks are usually earning or performing better than the bonds. So your portfolio is growing maybe to 65 to 35, eventually could grow to 70 to 30, and your risk is becoming bigger and bigger. That is why it's important to rebalance the portfolio to its optimal value, which we considered at the beginning was 60 to 40. So at some point of time, we do rebalance the portfolio on each individual ETF so that we get back to the optimal. This is not only good for your risk, but is also very good for your performance. And on average, we calculated that such rebalancing, if it is performed well, is gaining you an extra return of 0.4 to 0.5%. And I tell you why is that. Imagine
0.5 annually?
0.5% annually. So which is, it's almost covering
half
bad.
Of
our... Yeah, and we've been very much surprised that it really worked this way. And I tell you why is that. For example, when you had a situation like this we had in the COVID crisis where the markets dropped 30%. So having your 60% in stocks, which dropped by 30%, so currently those 60% went to 40%, right? And in order to get back, this 40% would have to make a 50% rise. So from 40 to 60, you need to have in the portfolio needs to grow by 50%, the stock portfolio. But if you rebalance at that point, so you're going from 40 to 60, you only need to get 30% rise in order to get those 20 extra return. And for example, during this COVID crisis, or around 45% of our portfolios has been rebalanced, and we will be putting an article shortly on our web to evaluate the performance of the rebalancing. And I think the impact in this crisis of the rebalancing will be around 2 to 3%. It helped in terms of return to the clients, and we don't do it we don't do the rebalancing on like a time basis. So for example, each month or something like that, but we only do the rebalancing when let's say the allocation of each ETF has moved substantially away, so has drifted from our optimal allocation. And we are not only doing the rebalancing based on stocks and bonds, but we are actually doing the rebalancing based on also actual ETFs. So for example, even a portfolio that is 100% stock ETF portfolio, we are doing a rebalancing there because there are periods, for example, the first decade of this century has been a decade where emerging markets and small cap stocks has been outperforming the market a lot, while the second decade was the decade of S&P 500, where the biggest companies has done the best return. And you never know at what point of time which segments of the economy are going to perform well, whether it's going to be small caps, mid caps, large caps, or emerging market caps, European stock or American stocks, etc., etc.
And you rebalance portfolios automatically, so I don't have to bother about that. Okay,
yeah,
that's nice.
Also a very
big advantage of a robo-advisor, that we do rebalance the portfolio automatically. So, and we look at each individual portfolio each week, and we check, okay, how is this portfolio this week? Do we gonna rebalance it or not? And for example, in some of the states, like Slovakia, Czech Republic, we also consider the tax benefits. In Poland, you don't have such tax benefits available, but for example, in Slovakia and all these countries, when we do rebalancing, we also look at the tax consequences to even improve the performance or not to pay any taxes at all, which in all countries in Central Europe is possible so far, only except Poland. But I believe also Poland will come with some tax or social security benefits when now the new regulation of pan-European pension plans are coming, and most of the Central European states are gonna give some incentives for people to save through these schemes. So let's see how Poland is gonna do.
But even in Poland, if you're using ETFs, you can offset your losses from stocks, for example, with benefits, with profits from ETFs. So it's also can be used in optimal way. Okay, so
yes, but obviously you want to have gains both on ETFs and both on stocks, you know. So,
but if you're using mutual funds in Poland, you can't offset your losses from stocks. So that's the downside of mutual funds, one of them. And you just used the term of robo-advisor. What is that, and how does it work, especially in Finax? Because it's very, very interesting.
So this is a new trend is coming from US, where it's a type of asset management where the client doesn't need to take care of anything. He just sends the money and it's all he does. And probably at some point of time, he's going to withdraw the money when he needs it. So basically, what the robo-advisor does is that in long term, advisors has been the biggest cost of distribution of investment solutions or investment products. And it's been developed in US that, okay, let's cut those costs. Let's try to automate this. Let's try to, based on those questions that the advisor is asking, we can ask electronically. The portfolio selection can be done automatically. The investing of the funds can be done automatically. The rebalancing can be done automatically. So, and this is how the robo-advisor has started its way, that most of the things has been automated in order to lower the cost for the client, because the lower the cost, the higher the profit for the client, obviously. But on the other hand, we are not saying that we are just getting rid of classic advisors like physical advisors. Most of the robo-advisors still have some, in US, not in Europe. In US, a lot of advisors are also working with physical advisors, and it's also the way we've decided to go further. So we created some kind of I would call a hybrid model. So we not only work with clients that goes, that can register our service directly, but we also work with advisors that we try to facilitate for them the process of onboarding the client, making it extremely simple for them, getting rid of any mis-selling. So the advisor is fully concentrated on the sales of the product, rather than trying to consider all the aspects, trying to find the best portfolio, trying to etc. etc. So we are trying to make it extremely easy also for the advisors to sell investment products.
Mm-hmm. So one of my last questions are, Finax looks really good, and the platform itself is intuitive and quite looks really good. And my question is, what about the safety of my funds? Because you are from Slovakia, I'm not sure if it is safe to invest in broker, maybe not broker, but to financial institution from Slovakia. Is it safe?
Yeah, sure, it is very safe. Actually, it's actually safer than any Polish broker. So we have a license. So we are a licensed broker, so which would stand for Dom Maklerski in Poland. but we are licensed to operate Europe-wise. So we are passported to all the countries. In the investment world, or for dom maklerski on brokers, all states has special investment guarantee funds that would cover any fraud of the brokers, which in Poland, this coverage is up to 20,000 euros, while all clients of Finax, even if it is a Polish client, is covered by Slovak Guarantee Investment Fund, which covers any fraud up to 50,000 euros. So in terms of possible fraud from the side of the broker, the Polish clients are better off with Slovak broker. But plus, we still have the same regulation on the segregation of funds must apply. That means all the clients' funds are keeping segregated from our company's funds. So even if the company, the dom maklerski, whatever dom maklerski, it's either us or any Polish broker, if it goes bankrupt, the national bank, in terms of Poland, it would be KNF, or in terms of Finax, it would be National Bank of Slovakia, will appoint another broker or bank that would start to manage the funds of the client. But in normal terms, I don't touch the client's money. And in Slovakia, we have a very good track record, because so far this guarantee investment fund has never been used to protect, because there hasn't been any fraud in the history in Slovakia, which I believe is not the case in Poland. And there has been few cases where the schemes has been used to fraud the clients.
Mm-hmm. So why did you decide to open your platform for Polish investors?
I love Polish investors. No, and, business-wise, we wanted to operate in Central East Europe, where we believe not many Western players are coming to target Central East European customers.
That's true.
And obviously, Poland is the biggest market in Central East Europe. So if we wanted to expand our operation, Poland is the number one market we should focus on. And it's very culturally, we are very close. And we understand, each other pretty well. And also,
but we're talking in English.
Yeah. I mean, I would say understand culturally. So, okay, the language is a little different.
In terms of language, either.
And also, our investor is Mr. Hrenko, who is the richest guy in Slovakia. He's owner of Haberavis. He's got also very close to Polish market. You probably know the Warsaw Tower, the highest building in continental Europe that is being built currently in Warsaw. So it's being developed by his Haberavis company. So basically, we are very close also to Poland through these connections, and also to Czech Republic. And these are the markets, including Hungary, that we want to concentrate in coming months and years. And then once this gonna be successful, we would probably move further to countries like Bulgaria, Romania, Croatia, Slovenia, maybe Ukraine, outside the European Union. So those are the markets that we at this moment wanna concentrate on.
Mm-hmm. And my last question will be about your investment journey. Why did you decide, because you mentioned that, why did you decide to switch from Forex brokerage to ETFs? That's the good question.
Well, I've been in this business for 15 years, starting with active trading, then switched to even more powerful active trading, which was Forex. And after 10 years of doing that, I realized most of my clients were losing money. I realized, even though we've been hiding behind investing, it was not investing. It was rather like an investment roulette or investment casino, where especially in Forex, the gain was either a red button or a green button. And I've had some turbulent time as it's related to my health. I have had a cancer, and going for chemotherapy, I realized, okay, this is not the life I want to live anymore. I want to do something else, and I want to do something that when I look back, I can say, okay, this, clients has earned a lot of money. I would be proud of the business I'm doing. I don't want to, I want to be doing something fair, something reasonable, something that makes my life happy. And that's why I founded this. I'm doing it at this point the right way. I'm doing it the way the client wishes, and hopefully, we will be earning much more money than any other type of investment, and that's what my aim is. I mean, I want to create a very fair, stable, and a product that will eventually earn the client the best money at the best possible risk, let's say.
That was my last question. Juraj, thank you very much for your interview. I was talking with Juraj Hrbaty, CEO and founder of Finax platform. Thank you very much.
Thank you very much as well.